Good afternoon. Welcome back to the Gatewood Wealth Solutions Market Commentary broadcast. This is John Gatewood, and I am here joined today again with our Chief Investment Officer, Aaron Tuttle, CFA. Welcome, Aaron.
Thanks, John. It's great to be here.
I like to pronounce that CFA because that is an incredible.
There are other letters.
There are others, but we'll go into those another time. But before we start, I want to let our audience know that we are launching a YouTube channel, a GWS YouTube channel. So you'll be able to listen to all prior broadcasts once they're posted. So we hope to have it up and running in the next couple of weeks. So we're very excited about that. Well, the big question now is, when will the economy be reopened? We know we are past the infection and death peak. So now it's a matter of time.
We assume.
At least the numbers seem to indicate that. So let's hope that's the case. Today, we're also going to talk more about our market outlook and how does this compare to our initial bull, bear, and base case scenarios. And lastly, we've talked previously about bonds being at risk and overvalued. So Aaron's going to speak to us about how bonds work. We're going to educate us on bond risks, the types of bonds, and which ones have less risk and are preferred given our views at this time. So Aaron, let's begin.
Okay, John, let's review the timeline. Last week, we mentioned the new cases were peaking and expected the daily death rate to do so as well. And I'm happy to say we are on track. Our timeline indicates the U.S. will begin to relax the shutdown near the end of April. The key word being begin. This too is on track. You can see the daily new cases and the daily new deaths are now declining. And yesterday, it's not in this slide, there was a spike, but the New York Times reported a change in the way COVID deaths are calculated. Quoting the paper, New York City, already a world epicenter of the coronavirus outbreak, sharply increased its death toll by more than 3,700 victims on Tuesday, after officials says they were now including people who had never tested positive for the virus, but were presumed to have died of it. And whether you agree with the rationale or not, it should be a one-time spike since this brought forward previous deaths, that is, barring additional changes or reassessments. But there are signs of relaxing the shutdown. They are growing. Republican governor of Texas, Greg Abbott, said he plans to allow businesses to reopen with an executive order that will lift the coronavirus lockdown in a safe way. Details of the executive order are expected to provide businesses with a list of guidelines on how to safely reopen, to include testing for the coronavirus. The governor announced that Walgreens locations would soon offer a test that could be administered via the drive-through window and will provide results within 15 minutes. The president and administration will be watching closely. You can be sure of that. President Trump mentioned this would be his toughest decision of his administration to date. Now, yesterday, and I'm sure this is not a coincidence that it was purposely done, the Washington Post leaked a draft plan to reopen the economy. The plan would open child care facilities first. There would be a requirement to be tested for the virus, as well as other well-functioning monitoring systems within the society. Areas least affected by the virus would open sooner, with additional preferences for areas with robust healthcare systems. There are growing reasons to begin relaxing the shutdown, but there is still the fear of a second wave. Sweden did not issue stay-at-home orders. This may provide insight on how much of the slowing of the virus was natural versus a government intervention. If Sweden has a similar experience as other countries, then this could suggest the slowdown in the US and others has run its course and a significant second wave is less likely. If Sweden has a worse go of the virus, then that would represent the remaining susceptible population in the US and other countries, and the possibility of a second wave. Remember, the flattening of the curve only slowed the pace of infection. The same amount of people will still need to be infected for the virus to abate. Know that we have an eye on Sweden. Now, while everyone focused on COVID-19, our attention is shifting to that oil price war that we talked about several times now. Now, each time I review this section, it becomes dated. There's just so much that's going on. So I apologize if I do not cover the most recent changes. But the OPEC deal to cut production, we think is lacking. OPEC will cut 9.7 million barrels a day, just below the initial plan of 10 million. However, this is a world where there's now 36 million less oil barrels in demand each day. It just is not enough. In addition, Mexico was considered the winner in the quote unquote Mexican standoff with Saudis. Mexico is just cutting 6% of production instead of the 23% cuts for other members. Now the cut leave the US as the biggest producer of oil, with the US avoiding cuts by claiming it's all organic decline for them. They're going to lose 2 million barrels over the next next couple of years. Of course, that means unless prices rise and then they actually put on more oil, right? So what's our take? Well, this is the second time in less than 5 years that the Saudi Arabia OPEC-driven cartel has attempted to control prices through production, and it was not achieved. The oil cartel now has many more players than it did in the 70s and 80s, and they have many more options. Game theory would suggest as more players enter, the less effective the cartel will be due to cheating. Now, we are in agreement with Goldman Sachs on a short-term call for $20 barrel on their $20 barrel forecast. We believe this is a supply shock, and it's not going to be met by cutting production. The way out is to increase demand or a slow process of driving the high-cost producers out of the market. However, we think the demand story has potential. Since September, the stimulus provided through fiscal and monetary policy is just staggering. The recently passed CARES Act was $2.2 trillion. The Fed will make up $4 trillion in loans to businesses to rescue the US economy. Then there's the $2.3 trillion with a T in additional programs the Fed announced on Thursday, April 9th. Finally, the Fed's QE program, which returned in the repo markets in mid-September, has an estimated $2 trillion of additional bond purchases. Altogether, the total sum amounts to $10.5 trillion. This is approaching half the US GDP. This certainly could drive demand up. Now, by the way, many are receiving their stimulus checks this week. Please check your bank account that you use to file your taxes to see if you received a stimulus check. Remember, you don't necessarily have to file. It could automatically send that check. Now, a lot of people are also saying that most of the websites for banks are slow to just denying service because so many people are checking. The current recovery is following that V shape, at least so far. But instead of discussing equities, like John had mentioned previously, I want to spend some time on fixed income. In our previous call, we mentioned inflation risk as high, but that doesn't mean certain. But we have a belief that bonds are overvalued and equities are undervalued. But first, let's discuss the purpose of bonds in an investment portfolio. They are to reduce uncertainty, which dampens volatility in a portfolio in the short term. To better understand this and how we are approaching bonds, let's review the characteristics and risks of bonds. Bonds have a contractual obligation, which are known beforehand. This is why they have greater certainty than stocks. Here's an example of purchasing a $1,000 bond with a 5% coupon, paid over 10 years, with the original purchase amount returned and the final payment. The payments are all known beforehand and contractually obligated. So long as you do not sell this bond, this is what you will receive. Nothing more, nothing less, except if the bond defaults. But if you buy government bonds, there is no risk of default. But this is not to say there is no risk. The first risk we'll discuss is inflation risk. In theory, there should be a natural or real rate of interest plus an inflation premium. Together, they equal the nominal interest rate or the coupon at the time of issuance. We believe inflation risk is high. However, Treasury yields are currently below the current low inflation rate. Whether high inflation is realized or not, a 10-year Treasury is losing purchasing power in the current low inflationary environment. JP Morgan has a great slide on this reality. We know the yield of a 10-year Treasury at the end of March. It was 0.7%, not 7%, 0.7%. Using that previous equation, we can subtract the current inflation of 2.37% and determine the real yield is negative 1.67%. Or we can look at it a different way. The blue line is the current yield curve. The dotted line is yield curve in December of 2013. You can see how much the interest rates have dropped over the last 7 years. Now, this shows bonds ranging from 3-month terms all the way out to 30 years. The fuzzy line is the current inflation rate. All Treasury bonds are below inflation rates. It does not matter the term. Now, despite certainty of meeting the contractual payment obligations, even if inflation was to stay at this level, being low, a 30-year bond, now this is before taxes are even taken out of the yield, would lose 35% of its purchasing power by the time it matures. That's approximately the same loss in the S&P 500 from its February high to the recent low. Once again, this is at today's low inflation rate. Now, not all institutions are able to print money and therefore guarantee payment. To compensate for this risk, a risk premium is added to the nominal rate of the bond. In theory, you would increase the yield of the bond by the probability of default. Assume one payment is expected to be missed. You would then increase the other payments to offset the default. In the end, the received money is expected to be same as the similar termed Treasury. Now, this is an oversimplification. A bond is unlikely to default on a single payment and never pay it back. And they could default altogether. However, this concept works well across multiple bonds. Also, this is important for later. Forecasting defaults is never accurate, and most assume higher defaults than what will actually be realized. So a bond investor ends up receiving more money than the similar termed Treasury. Consider that a risk premium. We have covered 2 bond risks, both dealing with payment, the return of your money, and the purchasing power of your returned money. Let's move to the third risk, interest rate risk. The risk is best divided into 2 separate components, the bond price risk and the reinvestment risk. The duration, which I'll define later, is what separates those 2 risks. This is often depicted with a teeter-totter, and the board shows the direction of your account value over time. Using the previous example, if you bought a bond paying a 5% coupon each year, you will get $50 each year, and the last receiving that original $1,000 plus the $50 payment. But what do you do with the $50 coupons each year? If interest rates stay the same, you could invest them into bonds paying 5% as well. Your compound rate of return will be 5%. The board was going to be that level of that 5% compound rate. But what if interest rates decreased to 4%? The value of your bond, the bond price, would increase, but you would not be able to reinvest that 5% coupon at 5%. It would now be reinvested at 4%. Your compound rate would be less than 5%. Initially, the account value would rise, but the drop below the original expectations. So you would have less money at the end due to the reinvestment risk. Now, what if the rates increase to 6%? The value of your bond would decrease, but you would be able to reinvest the payments at 6%. Your compounded rate would be higher than 5%. Though your account initially drops in value, ultimately, you would have more money at the end due to the reinvestment at higher rates than the original bond. The pivot point would be the duration of the bond, which is a measure of the bond's sensitivity to the moves in interest rate. Now, there's an easier way to think of it. It's the point when you get your money back despite any changes in the interest rate. Now, based on this, the higher the coupon, the higher the payment you're receiving, the sooner you get your money back. There would be less variability in the bond price with more variability in the reinvestment risk. Now, the lever or board represents the account value, but the length can also represent the maturity of the bond. The longer the maturity, the greater the variability in the bond price swings. A shorter maturity would have less variability around those risk factors. This may help when we say we are favoring short duration, higher quality paper, that you're going to get your money back that was contractually obligated, and that you're going to have bond prices less susceptible to the decrease, and you will quickly benefit from that reinvestment risk or that reinvestment opportunity at that time. Now, cash would be on one extreme. The duration would be zero. There is no variability in the price of the dollar. A dollar is always worth a dollar. And you would immediately see the reinvestment risk show up. The other extreme would be a zero coupon bond. There is never a coupon, so there is no reinvestment risk, only price variation. And we don't know when rates will rise, and the Fed intends to keep them low. But it's hard to say that they can go much lower. Yes, Europe is negative, but not by a lot. We will eventually see rates begin to rise. In a rising rate environment, you want less bond price variability, that's short duration, to take advantage of the reinvestment risk, or what we would consider at that point a reinvestment opportunity. You want to ensure you receive your money back, higher quality. And you need to offset inflation, which most bonds are not doing at this time, indicating the significant overvalue. And the market is coming off a bear sell-off, and the market is therefore deemed undervalued. So we favor equities. Let's look at the interest rate sensitivity of the different bonds. Now, this is assuming a 1% increase or decrease in interest rates. Treasuries could rally, but only the 30-year is positive after a 1% drop. Remember, the 10-year was at 0.7, where the 30 is at 1.35. A mere 1% increase, though, on a 30-year Treasury would have a price drop of 21%, or a bear market in Treasuries. And that's just 1%. What would 2% do? Now look at corporates, convertibles, high yield, and floating rate. They all have better downside protection. And remember, we want to keep that, we want to have some protection of principal in our bonds. So when we look at US Treasuries, they do not meet our criteria. They do have quality. Actually, they're the highest quality, but they fail the other three. US Treasury inflated protected securities are better. They mitigate inflation by linking to the CPI. The value of your bond will increase as the CPI goes up. But this assumes the CPI reflects the basket of goods that you purchase. Now, there's been a lot of tampering with the index to mute the increases. There's economic arguments on why that is right and wrong. But truly, I would rather have the PPI as the price escalator. Unfortunately, the government is going to listen to me. But one thing is for sure, the tips for an inflation protected security relative to treasuries are certainly better. Corporate bonds, well, they pay higher than treasuries, but they are near inflation. And this is where the treasury should be. So there is little mitigation of the risk. They are higher quality so long as they are not below investment grade. The other two are not met by all corporate bonds. If they have high equity correlation, then they are likely low quality. And if they have shorter duration paper, they'll likely pay well below inflation. A floating rate is another option. The rates adjust, so if inflation was to increase, it should move rates up. And many bonds are already paying below inflation, but nonetheless, it is certainly better than a fixed rate. The bonds do adjust that rate, so the duration is near zero. It's similar to cash on that component. Their quality, though, is similar to junk bonds and are often subordinated debt, so you're last in line whenever it comes to repayment. The only people behind you usually are the equity owners. So we definitely do not meet credit quality requirements here. They are also used heavily by energy companies, specifically the shale and fracking companies, all of which did not get to participate in the recent stimulus package. And well, you guys had heard our call that we believe the price of oil is going further down in the short term. Let's move on to high yield. They meet many of the requirements, but for all the wrong reasons. Their yields are high because the default risk is high. So that means credit quality is low. The higher yield does certainly shorten duration. That default rate is highly correlated with equities because it's tied to the ability of the company to pay, meaning the company needs to be strong. And if it's a strong company, they usually have rising stock prices. So yes, it is correlated to equity, but what about that vice versa? If they're weak companies, we don't think this is the type of equity correlation or a way to get the equity correlation that we want for our clients' fixed income portfolios. So we get to, go ahead and skip this slide, John. Let's get to convertible bonds. These are unique instruments and one we favor coming out of sharp sell-offs. We've had them in the portfolio before. They are a combination of a bond, and that bond acts as a floor. But they also have a call option on the stock. And they meet all four criteria. They have that synthetic equity component that allows for conversion to equities, which helps mitigate inflation risk. The bonds tend to be non-rated. Many assume they are junk, but often they are the highest quality bonds. The reason is well-known companies, let's say Salesforce is an example, uses convertibles to avoid paying a rating agency hundreds of thousands of dollars for a rating since the market is already familiar with them. The convertible markets has historically had a relatively low default rate of 1% to 2% compared to high yield markets of 4% to 5%. And that's just normal markets. We're not even talking about whenever it clusters during strenuous markets like we've been experiencing. Now, due to that conversion option, most are converted to stock and never mature. So it's difficult to assign a duration. Nonetheless, they have characteristics of shorter duration bond funds. The equity correlation is high when stock prices are high, since the conversion option is more valuable. That means the conversion to equity. Now, when stock prices are low, then the bond acts as a floor. They trade more like bonds because you don't think that you're going to be able to convert to stock. This is the kind of equity correlation we want in clients' portfolios. To recap, we are currently using convertibles as a way of tilting from fixed income to equities, but long-term, we do want to actually move into actual equities. However, this would get us into investment policy statements, and we want to cover that, but we want to cover that on another call. This has already been a fairly long call.
Thanks, Aaron. That's fantastic. Great summary today. And that's a great explanation about bonds, because that's one of the questions that we've been getting from our clients is if we think that bonds are at risk, why do we have it in the portfolio? And of course, the number one reason is that we want it to be the ballast to offset that volatility risk of the equities. So yesterday, the San Francisco Fed Chair, Mary Daly, said that the path to recovery is unlikely to be swift. This will not be a V-shaped recovery. It's an interesting perspective, and that her belief is that people will be slow to regain confidence that they can go back to work safely. What are your thoughts on that?
Well, I mean, everyone has their own opinion and everyone has their own models. And we have learned time and time again, this is just another example, that models are really not that great at predicting. We think with the coronavirus model that we created, we had a pretty good assessment of the overall trends, but it certainly has not been perfect, and you don't expect it to be. The market has been recovering through a V-shaped recovery. But one of the things that we have been talking about, and the reason we have felt that it will recover in a V-shaped pattern, is because of the amount of stimulus that is provided, not the economy. We have been separating the two because of how much intervention government policies are acting in markets. Markets should be a leading indicator of the overall economy. But when you step in and you prop up markets to stop the sell-off, then that's going to cause markets to move up. And you can have a bad economy with a stock market that is moving up. Now, I'm going to make this comparison. Don't hear me compare us to Venezuela. Hear me make an example that you can have a bad economy and a stock market that's moving up. So in Venezuela, they have a very bad economy. The restrictions on, or the inability to get toilet paper is minor compared to what the people of Venezuela are doing. They would love to have the access to the grocery stores and the goods and the things that we're able to purchase. Their economy is absolutely struggling. But if you look at their stock market, because they've been inflating for much longer and a much greater severity than the US to keep the market up, there's a disconnect. And that market in that currency is probably one of the best performing markets over many years. Now you convert that market into US dollars because of what they're doing with the currency, that would not be the case. So we are not saying that the economy is going to have a V-shaped recovery. Actually, this is unprecedented. No one really knows. And we've yet to open the economy just to see how much damage there's been done. And we're starting to we're hearing rumors, they've been fairly substantiated, but Gold's Gym apparently is not going to reopen their doors. And there's going to be many other companies that are like that. So we have to wait until we see the economy actually open to really have an understanding. But our call for a V-shaped recovery has more to do with the amount of stimulus that has been created.
Well, another point that we had talked about a little earlier is that while that comment about people waiting to go to work until they truly feel safe, there's also the circumstances around the cruise lines.
Right, that was a shocker and a surprise. So we saw some reports that cruise lines have increased reservations. Now, a lot of people have credits from their cancellations, and they're actually using it. There's also major discounts, but it just floored me that there is actually a lot of demand for cruises at the moment. People are actually trying to book cruises in advance. So that just goes to show that as much rationale and good thinking and education that you bring to the table, this is far more complex than we really have the ability to truly forecast.
Now, one of the things that we've heard from clients is, if bonds are risky, as you say, and of course you've given us a reason why we're in the bond strategy that we're in now, why not simply hold cash?
Well, that would certainly be consistent with three of the characteristics. Short duration, well, as mentioned in the slide, the duration is zero for cash. High quality, especially if it's FDIC protected, you would have certainly high quality. Probably wouldn't do much for inflation risk, but many things are not doing much for inflation risk. But the other thing is remember, we favor equity. So we wanted to take some of the fixed income exposure and have stocks. That being said, we certainly look at those characteristics And let's say the convertibles, the market does have that V-shaped recovery. The California Fed chair is incorrect. And all of a sudden, those convertibles have appreciated nicely in line with the underlying stocks. Well, they'll start to trade more like equities, and we'll start to reassess the risk because there would now be a lot more downside protection, or there would be a lot less, I'm sorry, downside protection because it would be trading more like a stock and less like a bond. So we would look to maybe take some of that risk back out of the portfolio. And I think cash is certainly an attractive option, especially if you look at, let's say, a 2-year or a 5-year Treasury. You're talking about a few basis points in yield with a lot of, well, not a lot, but still more downside protection than cash. We think cash is a strategic alternative. We just think that the convertibles at this moment will help clients' portfolios more.
We just had one of our listeners comment that, you know, our broadcast is being listened to by people all over the country. And when we say that the cases, the new cases and the deaths have peaked, that on a nationwide basis, that's true, but there are still parts of the country where they're still reaching the peak. How do you think that will play into the rollout of reopening the economy?
Well, when we look around and we look at a couple of things, one, the seasonality. So why did Russia, and even we talked about Sweden earlier, why did they not have as many cases, or why didn't they start as early? Why didn't they experience the same as some of the Western European countries or New York? It seems that the virus operates or grows at a rapid rate when it's a mild, dry climate in an urban environment. And there isn't many of those in the U.S. And now that we're getting into spring, it's warming up, and so that we think is going to help offset that. We are monitoring the other states, but let's look at some of the examples. Right, Washington and California had cases that arrived well before New York. Louisiana was also an early state. We haven't seen the type of rise in any of the other states, even with some of the states starting before New York. A later arrival was New Jersey, and New Jersey has surpassed those. So all of those are giving that seasonality component and the other factors credence. Granted, this is all anecdotal evidence. Everyone is kind of working off of it, of data. We are getting more data, but it does not. It looks like the New York case is really the epicenter, and it doesn't at the moment appear to be spreading in a significant way in other states. That certainly can change, and if the seasonality is wrong and there's some other factor that we're not aware of, that's the reason you have to continue to monitor.
You know, it's interesting to reflect on the risk of death by COVID versus other causes. So for example, if you go on the CDC website, they talk about how 2 years ago, there were 61,000 deaths by the flu. Mm-hmm. Another interesting thing is that for every 10 people that went into the hospital over the last 10 years that had the flu, 1 person died. That's a pretty high circumstance. Now, of course, not that many people on a relative basis go to the hospital, right? But if it does go down to that, get to that point where they have to go to the hospital, that's a pretty high death rate.
The numbers are, we still, what we'll need to do afterwards is do a blood test to find out how many people actually have antibodies in their bloodstream for this virus, to have a good understanding of what the true infection rate is. And then we can look at the death rates. From our models, it does suggest the death pattern is that this is below the seasonal flu for a fatality rate. The big difference here is it's new, so we haven't been able to confirm that with more scientific studies. And the speed of this virus, it certainly travels much faster than other viruses, including the flu. So that's where the risk is. And we also don't know how much the government intervention has actually slowed down the amount of deaths, and as well as the social distancing and people's behavioral changes. So there's just a lot of factors to consider there.
Well, another thing, we were talking about risks earlier, and it's interesting when you look at statistics about death from other forms. So, for example, in the United States, we average 38,000 automobile deaths a year. So should we all of a sudden shut down highways and roads so we save those people from dying? What's even more interesting to me is that globally, it's 1.35 million or 3,700 people per day that die of auto accidents. Much higher than what the coronavirus would kill in one day. But our reaction to this is so different than what the risk is for something that's completely ordinary, getting in the car and getting on the road.
Yeah, our brains are wired to pay attention to the obvious and most relevant risk. We are actually, as a species, and models are not, we are not that great at assessing risk as a comparative component. So an example that we often use in the financial world is shark attacks. They happen every few years. Somebody will be out swimming in the ocean, and the news will catch stream of a person being killed by a shark attack. And that type of information in the news will catch a lot of attention, catch a lot of viewers, and people will be very aware of the risk of sharks. And if they go to the beach, they'll decide to stay on the beach and not go far out in the swimming. And they tend to sit under coconuts. And there are far more deaths by coconuts falling on your head, though that's probably not near as high as automobiles, than the risk, but of getting attacked by a shark. But you just think of how used to sitting underneath trees and how unfamiliar the risk of a shark is. It's not that people are dumb or whatever. We're just not good at assessing these abstract risks.
Who's going out there and counting the people that die from coconuts falling on their heads?
Oh, that was my previous employment.
Well, the one thing I'm not going to do anymore is just sit underneath a coconut tree until I got enough.
Well, that risk is also very low. Let's talk about sitting underneath in the sun and what the sun rays can do without sunscreen.
Now, looking at the oil industry problems, because that really was the second black swan,
yes,
not just the COVID event. How would you see this factoring into the recovery?
Well, typically a drop in the price of oil has always been considered like a tax cut. Oil is an input for so many products, and you just cut the price. Well, when you cut the price, you increase demand. So that a low price of oil often is considered some tailwind to the economy and a good thing. At these prices, though, you get some defaults, and you can get a waterfall in defaults where one problem infects another area, and affects another area, and affects another area. So it's really hard to tell. And in addition, as mentioned earlier, the cartels are not able to cut these production. There's just too much production. I was just absolutely amazed to think about the U.S. is the world's largest oil producer right now.
Isn't it amazing?
It is.
When I started this business back in 1981, we were so dependent upon the oil cartel, and now we're the largest producer. That's remarkable.
Right.
But so when we look at this $10.5 trillion of stimulus, that's a big number.
Right.
And one of the things that we've always been concerned about is the increasing amount of federal debt.
Yes.
Right. Now, one of the things that people have said, oh my God, this is adding to the debt, 10.5 trillion. But there is a factor of repayment. In other words, so you have money that's being given, the $1,200 to each person, and then some of that's paid back through taxes, I believe. Now, unless it's a non-taxable event, that's something I'll have to find out. But the other thing is that most everything else is through loans. So all the business relief is through loans that have to be repaid, with the exception of whatever qualifies for the Payroll Protection Act loan for forgiveness. So it's not as if 10.5 million or is all
Trillion.
this, or trillion. Good
At
point.
some point, we're talking about real money, right?
Yeah, right. It's just a couple more zeros. And because I remember back in 2008 when they had TARP, I mean, the one unique thing about TARP is that all that money had to be paid back with interest.
Right.
So yes, it was money that was created, but then it was paid back. How does that factor in our thinking in terms of the impact of this specific stimulus relative to the future total aggregate debt?
So that's one of the reasons that we're saying inflation risk is high, because there are other components. We had talked about them on the previous call on how people spend the money. A couple of things that are different from 2008 is you had a banking crisis. And most of that money actually didn't make it into the economy. The Fed purchased bonds and took them off the balance sheets of the banks and gave the money to the banks, and then they enacted, or took an act of Congress that allowed them to pay interest on excess reserves. So the banks looked at what they could loan the money out at risk, or they could loan the money to the Federal Reserve for pretty much the same interest rate. They never loaned that money out. And it's a fractional reserve lending system. So the Fed is not the only institution that creates money. Each of the commercial banks and the retail banks all have the ability to expand the money supply as well. Most of the money in 2008 didn't find its way in there. It still found its, we have had inflation. There wasn't deflation. Inflation was low. So it did make its way through. But I would say one of the big items to be concerned about is when we spent the money on TARP and we jumped substantially into the near $1 trillion deficit spending, that deficit spending didn't go away. It stays on the books. Once you hit a certain level, it's like a ratchet. You can click, click, click up, but it really doesn't go backwards. So here we are increasing the deficit spending again by the government. Is that, once again, ratcheting the spending up to not see it drop back again? Well, that's one concern. Another difference is this money is going, if we did the GDP equation, consumption, C plus I, plus government spending, plus net exports, right? Instead of it going into the banking system, it's going directly to consumers. And the $1,200 check, there was a $600 check in 2008. The new thing is the amount of loans that are going for investment. The consumption and investment, we think, is what could drive the inflation consumer price up. It's yet to be seen. There are all kinds of things that can happen, including just the psychology of people. They want to continue to build and take that money out of circulation. And banks, if they don't want to lend the money whenever they're storing it in, then we could see a continuation of low inflation. Another thing is the investments by businesses could bring on automation. I'm sure that's one of the ways that they are thinking as they're onshoring and bringing industries back from low labor cost countries, that they're going to come up with savings through automation. And that automation could help mute the cost or the rise in prices of goods. So by no means is this saying that, oh, it's for certain we're going to have inflation. And definitely don't hear us say that it's going to be a Weimar Republic type hyperinflation. We don't see that at all. We just see the inflation risks being high. And then when we look at the current bonds and fixed income and other items that are paying less than the current low inflation rate, and you compound that over time, we just think it's better to start looking elsewhere than things that are more susceptible to inflation.
Well, thanks, Aaron. You have provided relevant and timely information as usual. And thanks again to our audience for listening in. Much will be in store this week and next as the government checks signed by President Trump, apparently.
One more thing, though.
Oh, yes.
So you had mentioned that we had a lot of questions about fixed income.
Yes.
And doing these weekly commentaries, it is actually beneficial to hear from clients on what they want to hear about. We have to come up with content and ideas, and we did get so many of the questions about fixed income that we decided to devote this call to that question. So if you have things that you want to hear about or questions, we are absolutely interested in hearing that so that we can address those in these calls.
And the other thing, as we mentioned last week, is that if our listeners have a family member or friend who is interested in tuning into our weekly broadcast, please pass along that person's email to your lead advisor and we'll get them on the invitation list. So be safe. We look forward to having you back next week. Until next week, so long.